Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil, and uranium in a separate video. I'll leave a link for that in the description section below. As always, this is general commentary, doesn't take your personal situation into account. With all that said, let's jump over to our first chart. So I'm going to start with the S&P 500. And it's another look. The series of all-time highs continues. It's been a relentless move forward over the last several months now, and it looks likely there's more to come. Every pullback is seems to be quickly finding buying interest coming in, and that momentum remains to the upside. And the same applies when we look at the NASDAQ, just looking at the price action over the last few days. Looking at the rally off, got close to the 50-day moving average a couple of weeks back. Strong rally to a new all-time high. Then we've had this sideways consolidation. Looks like it's shortly going to resolve to the upside. So this is a trend that really I just don't think we want to stand in the way of. And just coming back to the S&P 500, I think if you're already long this market, if you're already long the S&P 500, whether it be the index or the stocks within it, then I think the decision of what to do at this point in time is straightforward, and that is let profits run. Yes, the market does look stretched. It's been a big move off this October low. It does feel like it's getting stretched, and it's had an extended run above these moving averages. So I've got the 50 and the 100-day moving averages, and the market has been trending. The S&P 500 has been trending above the moving averages since November. So that's a pretty extended run. But there's nothing here to say that won't continue. I think one of the issues for many people or many investors is they get out too early. And I'm sure this has been the case the whole way up. People think, look, can't go any further. I'm going to get out before it tops out. And I think the best we can do in these situations is just let profits run and use those trailing stops to limit our downside, because no one knows how far these upside moves can go when they really do get going. And I think also that when I think about, like, as for buying here though, so if you're already long the market, I think that makes sense. Use those trailing stops, let it run. But as for buying here, I think that's a harder question. And the thing we've got to remember is that every trend, no matter how strong it is, at index level, every trend ultimately comes back to these moving averages. It's and I can't see, and this one won't be any different from that perspective. But we don't know when, and we don't know from what level that's going to happen. So it's completely feasible that this continues to run for some period yet. Maybe we see prices up above 5,200, but then maybe a multi-month correction begins that brings things back to 5,000 or below. We don't know. That's not a prediction of what will happen, but it's just like how this could play out. The momentum could continue on, but ultimately we do come back to those moving averages. So that's why I say it's not so much of a clear-cut decision if you're thinking of buying now. And the other thing I'm doing is I'm also keeping an eye on bond yields. So just going out of the 10-year bond, and it's been fairly quiet over. A lot of the action happened over the November-December period. We've got a large decline in yields. The last few months have been quieter, and there's been gently moving its way back up to above the moving averages. Moving averages are saying to turn and getting close to crossing. We've also got a tight consolidation, a strong move higher. Tight consolidation often leads to a rebound and higher levels. So maybe we're heading into a period where bond yields could increase. So that does add an extra element of risk to buying the S&P 500 now, as opposed to just letting profits run. So that's why I'd be hesitant towards entering new positions. But I think there is another option which is worth considering if you're looking to get exposure or get more exposure to the market. I'll tell you about that in a moment. First of all, though, if you're getting value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching, and YouTube does what it does and shows other people. So please do those things. Now, what I want to do now, I want to jump over and have a look at the Russell, the small caps, because this is looking increasingly interesting. The Russell got within a whisker just on Thursday of a new high, not an all-time high, but a new high for recent times. So this is a December high, and yeah, we're really close to breaking above there now, close to a breakout. And one of the things I like about this chart is that it looks like there's accumulation of these pullbacks. So you look at the rally from the October low, from below the averages to above the averages, then pull back to the 50-day, strong rebound, pull back to the 50-day, strong rebound, pull back, strong rebound. So for me, these three retests and the quick ensuing rallies, for me, that suggests you've got that accumulation on the pullbacks. There's interest in buying this market. So from a risk reward play, I think that the smaller stocks are the most interesting sector of the market at the moment. And overall, when we compress this chart, have a look, take the whole picture in, it does look like this is a large basing pattern which is now in place. And I think this can act as a platform for ultimately for new all-time highs for the Russell, for the small cap. But I think that I think that could take a while still. When I say acting as a platform, I'm not talking about next month or a couple of months later or 6 months' time. This is probably something that maybe could get underway over the next year, maybe the next 18 months. Certainly could happen faster, but that's not something. Look, it's not something we know. We can never know the timing of these things, but I think the potential does open up. I think this trend in the Russell could be really just starting to get underway with the way that we're seeing these rebounds off the moving averages. And just looking at the most recent price action, I think a close above the December high is a signal to watch for. I don't want to preempt a break. Given what I was saying about the 10-year, there's always a possibility that this market does pull back, does some more backing and filling, because this was a strong run off the October low. But if we do get the breakout, maybe giving it a little bit more leeway, maybe using, say, around 2,100, just a little bit more leeway above the December high, maybe using 2,100 as a marker. I think that allows for a relatively low-risk entry point for a potential move back towards all-time highs. So hopefully that's been interesting. I think we'll leave that there for this week. And look, thank you for joining me. Look forward to coming back, talking to you again next week. Till then, bye for now.